Hello, welcome back to Manward. I'm Alex.
I'm Andy.
And today we are talking about some of the key definitions and terms involved in trading options. Now, if you are just coming to us and you missed our last video, we talked about why options are a powerful investment tool and how they should be a tool in every investor's toolkit. If you missed that one, we'll link to it. Go ahead and check it out. But today we really want to get into the to the guts of options and what makes them work. I think this is what trips people up a lot, is that there are a lot of unique terms related to options, and it scares folks.
So we're going to make it super simple. We're going to take baby steps into it. Just like, learning a new skill or a new talent, you start with the basics and build on it from there. And once you get the vocabulary down, the mechanics of it, then you can start adding some more tricks to it. So today we're going to start with those definitions, the key things you absolutely must know. Don't worry, there's only half a dozen or so. It's pretty simple and easy to understand. I can do it. We're going to get into it and explain everything you need to know to get started with options.
So Andy, let's start with call options. What is a call?
So a call contract is probably the most popular contract that's written every day. All it is a contract that gives you the right to buy a stock at a set price within a certain time period.
On the flip side, you have puts. What's a put?
Yeah, a put is just the opposite. It's a type of options contract that gives you the right to sell a stock at a set price within a certain time period.
Buying calls is essentially like betting that a stock is going to go up. Buying puts is the opposite. It's shorting, it's betting that the stock is going to go down. So you mentioned a certain date. Let's kind of get into why are dates so pivotal, and why is that such an important piece of the contract?
Sure, and that's probably the most powerful part of an options contract is they have what we call an expiration date. So if you have, you're buying a stock and going long, owning it for the long term, it's indefinite. You could sell it tomorrow. You could sell it 20 years from now, and there's no consequences of when you sell the price. With options, that's different. There's an expiration date. Most of the options that are traded every day expired the third Friday of every month.
So before we get too far along, let's take a look at what an actual option looks like. So you go to buy an option. This is what it looks like.
So in this example, it's a Cisco call that expires in January 2020. In this case, it would be the third Friday of January when that call expires. And the key thing there on that expiration is that strike price. So the definition there is the strike price is simply the price that you can buy or sell shares if you exercise the options contract. So if it's a call option, you'd be buying shares. If it's a put option, you'd be able to sell shares at that price. So again, in the example here, we see CSCO, that's the ticker for Cisco. It's a January 2020 call option, and the strike price is $37.50.
All right, so it's worth noting that none of this reflects the actual price that you would pay for the option, okay? This is just, think of it like a long ticker symbol. This is what you're going to see when you look up the different options contracts available to you. So Andy, what is the price called, and how is that determined?
So it's typically called the premium, and so this is the key where some folks get confused. If you go into like Yahoo Finance or your broker's account, you'll see a price, but it's not the total price you'll pay, because remember, each contract represents control of 100 shares. So the price that you'll see quoted to you is 1/100th of that. So in our last video, we used Ford as an option, and we talked about a contract that would have been quoted at 9 cents, but you'd end up actually paying $9 for that contract. So when you look at that premium in your broker's window or on Yahoo Finance or something like that, you have to multiply it by 100 to get the final price that you'll pay for that contract.
Yahoo Finance, Google Finance, any of these, basically finance. Go to any of these sites and you can look up what current options contract prices are, just the same as you would look up a ticker symbol for a stock. In fact,
one extra click.
Yeah, one of the terms that you hear a lot when people are talking about options is in the money. Phrases like in the money, out of the money. Can you really quickly run through what those are and what those mean?
Sure. A lot of people toss these around because it just sounds kind of cool. In the money, out of the money, and it's really simple. So we go back to that Cisco example, the 37.50 contract. So if the stock is trading below 37.50, it would be considered out of the money. If it's trading at 37.50, of course, it's at the money. And if it's trading above 37.50, the option contract is in the money.
We've gone over a lot of key terms related to options. So let's kind of run through those again really quickly. By now, if you've gotten to this point in the video, you should understand what these things are. We explained the expiration date, and the strike price, and why those things are so important. We talked about the premium, and then we also defined what in the money, out of the money, and at the money mean. All right, so we'll pause there for just a second. Go ahead, feel free to either screenshot this information, or if you want to get on a pen and paper, write this stuff down. Whatever helps make you a better investor, we're all for it. If you'd like these definitions and this information delivered right to your inbox, go ahead and sign up for Manward's free digest. There's a link in the description below. Simply enter your email address, and we'll get that information out to you.
So now you know what an option is, what it looks like, what all the key terminology is. Now it's time to start making some money with options, and that's what we'll cover in the next video.
Cheers to that.
Cheers to that.
Hey, thanks a lot for watching. I hope you found this video informative. As we've teased, there's going to be a lot more useful information on options coming your way. If you have any questions, go ahead and leave them in the comments below. Otherwise, be sure to subscribe, and we'll see you next time.